Good morning and welcome, everyone. I'm excited to be your host for today's webinar, Unleashing U.S. Real Estate Opportunities for Canadians. This will be a jam-packed hour where our guest speakers will present real, vetted investment opportunities for you. So my name is Dave Price. I'm the Director of Sales here at SVN Rock Advisors. And my role here is to build relationships and make strategic connections for the betterment of everyone involved. And this is why we're here today. So before we jump into today's exciting content, I want to give you a heads up of a couple of upcoming events that we've got running. In the series of Unleashing U.S. Real Estate Opportunities, we've got November 22nd. Save the date. We're going to have new investment opportunities to present to you on that date. So keep that one blocked off in your calendar. At the end of November, on the 28th, we've partnered with Informa at the Toronto Real Estate Forum, and we're running a one-day event. It's a live event called Apartment Development and Affordable Housing. It's a conference that we're running. And then a lot of excitement and enthusiasm. We've got the new iteration of Apartment Development Masterclass starting in January. It's an 11-session masterclass to teach families, children, grandchildren, and pivoting developers to really know and learn the ins and outs of everything to do with apartment development. So keep those in mind, keep those dates handy and ready to go. So everybody, we're in webinar mode. And what that means is, so we're protecting your privacy here, right? But what we want to encourage you to do is to use the Q&A section at the bottom of your screen. You see that outline there. Pop your questions in there as they come up, because we're going to allot some time at the end of the webinar to review your question with our panelists and get answers. And anything that we don't have time for, we'll deal with those after the fact through email and make sure everybody's questions get addressed in a timely fashion. So now, for this series of Unleashing U.S. Real Estate Opportunities, these webinars are going to live and reside on our website. You can see the URL up on the screen. So if you miss part of it or you want to rewatch it, you can go on the website and watch it right from our website. And all of them in the series will be there for you in perpetuity. So today's agenda, I'm really excited about this. So we're going to introduce you to the strategy, the strategic real estate deal making, right? And then we're going to feature two spotlights on U.S. developments and opportunities for you to invest in. That's the whole purpose. These are real live deals that you have the opportunity to invest in and buy. And then we'll go through next steps of how you connect and how we put people together. So I'm going to quickly introduce you to our panelists. We've got a great group of panelists here. We've got Larry Browning, who is the SEC, the Society of Exchange Counselors President. Larry is a friend of ours. He's also boots on the ground in Indiana. And Larry is going to introduce to you Mark Crane. Mark Crane is the VP of Investor Relations at Denton Floyd, and he is going to present to you one of the investment opportunities that Denton Floyd is working on. Then we've got Holly Mills. Holly is the Director of Brokerage at Clemens Real Estate. And Holly's got a for sale opportunity in Kansas City that she is going to present to our entire audience. And we've got Daryl McCullough. Daryl is a longtime strategic advisor of ours. He's a friend. He's a connector, also an SEC member. He introduced us to Larry Browning, who we now know very well. Daryl, it's going to be fun. He's going to interview Holly on the property in Kansas City. And as I mentioned before, I'm Dave Price, Director of Sales here at SVN Rock Advisors. Okay, so how do we do this? Strategic real estate deals. Now, this is all about collaboration. So we are SVN. We cover the entirety of Canada, and we leverage relationships. We leverage our connections. We have a vast network throughout Canada and the U.S. You can see all those pins throughout the U.S. on our affiliate SVN friends down in the U.S. Plus, we leverage our relationships of the SEC members, two of which are here today, in Daryl and Larry. Now, again, as I mentioned, this is a webinar format, so everything is confidential here. So if you have an interest, you have questions, put them into the live chat. This is where you're able to interact on this webinar, and we'll make sure anything that you want addressed today, we'll take care of that at the end of the webinar. But don't be shy. Please put your questions in. These are very smart people that have the answers that you're looking for. So now I'm excited. Let's get into it, right? We've got our spotlights. So first, what we're going to do, back to the agenda, is how this all fits together. Now, these aren't just any opportunities. These are pre-vetted opportunities. So our role here is to identify markets, opportunities, the boots on the ground. We validate and vet the opportunities. And that leads us to today, because this work has already been done. It's the spotlight. We are now putting these developments in front of our audience to allow you the opportunity to dig deeper and decide if this is something that you want to invest in. And then we'll talk more about the opportunity, the connections, and how we get the details and move things forward. And one thing I want to point out is we're vetting these opportunities because we ourselves, SPN Rock, are investing in these opportunities as well. Okay, now I'm going to introduce our friend Larry Browning. As mentioned, he is our boots on the grounds friend to all of us here. Larry, why don't you introduce yourself? And Larry's going to walk you through the whys about Indiana and Indianapolis and introduce our friend Mark Crane. Larry, over to you.
Thank you. Appreciate it, David. My name's Larry Browning. I'm the owner of the Evergreen Investment Corporation in the Indianapolis area and been in the real estate business approximately 47 years. Been a member of the SEC since around 1983, 84. And it was interesting when I joined the SEC, we began conducting meetings in Indianapolis and Indiana about every 3 or 4 years. And it was fun to watch the SEC members around the country as they began to learn a little bit more about Indianapolis and Indiana, just be fascinated with our market. So over the last 47 years, I brought a number of people into Indiana for our investments. We did a lot of value add investments back then. And so the SEC members have poured millions of dollars into Indianapolis and Indiana because they found a lot of positive things here. They found that you could still make real deals here, that there was availability of land, there was availability to buy properties at reasonable values. And so we saw a lot of capital come to this Indianapolis, Indiana market through the SEC over the years. And many of you probably know we're the racing capital of the world. That's what we're known for. We've got the Indianapolis 500, the largest single day event in the world that brings about 400,000 people into the Indianapolis Motor Speedway. We also have the Brickyard 400, and we're the drag racing capital of the world. You may or may not know we're also considered the amateur sports capital of the world. The National Collegiate Athletic Association is based here, plus many of your Olympic teams and various sports are based here in Indianapolis. And so we have a lot of offerings of sports opportunities. Naturally, you know, we have the Indianapolis Colts and the Indiana Pacers, but we also, in addition to that, are considered the crossroads of America. 4 major interstates meet right in downtown Indianapolis: Interstate I-70, I-65, I-74, and I-69. So we're close to the bulk of the population in the U.S., and so we're a distribution capital. We have a lot of transportation opportunities that go through Indianapolis, and so it's one of the places where you see a lot of job creation because of that. And then in addition to that, we have very strong education. You probably all know Indiana University, Purdue University, Notre Dame, Butler University, DePaul University, Evansville, Ball State, Indiana State, strong education. In fact, I did a technology park development here, and Purdue University backed that park. They were a part of our partnership for doing that. So the education community comes in strong to base help in our economy here. But I think probably the number one strength of Indianapolis is we have strong government. We have had good government here for many, many years. It's the Midwestern values and the conservative nature of our government. So we even have surpluses every year in Indiana. My wife and I received 2 checks last year because they were sending back tax money to us. So we have a strong, strong government that uses common sense. And it also helps in that development process because you can get your zonings done in a reasonable amount of time. You can work with local officials. We'll oftentimes have the government participate in some of our developments through TIF districts, et cetera. And so those strong government has been a major reason why we see a lot of productive investments in Indiana. And about 4 or 5 years ago, we found our market was so overheated and we felt like there was just so much capital chasing so many deals. My partner and I actually sold the bulk of what we owned. And we felt like that we might need to play kind of the game again of getting out of the market for a while and playing the cycles and jump right in later. But we were fortunate. We were approached by a friend of ours who said, take a look at this development I have down in Jeffersonville, Indiana, which is in the southern part of Indiana. And so we looked at the numbers, and even though with market was overheated, we looked at the numbers and said, wow, these are returns that we wouldn't expect this time during this overheated market. And so we began exploring further, began digging in and vetting out the developers involved with this. And we also began looking hard at the market. And we found it was everything that was represented. In fact, they actually represented lower than they thought on what the rents would come in at. Very conservative in their approach and a very dynamic investment for us. We put about $7 million into that transaction. And the next speaker is going to relay to you how that transaction went and let you know on some of the developments they've done in the past. But that developer was Denton Floyd, who is based in Jeffersonville, Indiana, which is just across the river from Louisville, Kentucky. And about 3 or 4 years ago, after we did that development with them, they began moving up into the Indianapolis marketplace looking for sites to develop here. So my son and I have been helping them find sites in central Indiana. They're getting ready to close on their 3rd site with us. And that's one of the developments they're going to mention to you. So I wanted to introduce you to Mark Crane, who handles investors relations for Denton Floyd. They're a very strong company. We found them wonderful to work with. They're honest, they're trustworthy, high integrity, but also what's important is their deals come in on budget. They do what they'll say they do, and they report well. We found that their reports are excellent. They're constantly communicating with us. And it's one of those relationships that we value very highly. And so we feel that the Denton Floyd way of doing business is a very profitable way of doing business, but it's also one of those developers that you really enjoy doing business with. They're fun to work with. So I want to introduce you to Mark Crane, Investors Relations, head of Denton Floyd out of Jeffersonville, Indiana.
Thank you very much, Larry. My name is Mark Crane, everybody. And as Larry said, I'm with Denton Floyd Real Estate Group. I'm a minority partner with the group. And much like Larry, I got to know these guys first as an investor. A bunch of people who had worked with me in some tech investing over about a decade had made some money. I'd made some money on a couple of deals. We started to look at real estate as an asset class to invest in. Met the Denton Floyd team around 2010, 2011. And I've gotten to know them now the last 12 or 13 years. And my career really has gone from being in tech to being in economic development, which I did for about 10 years, to now really being about real estate. And what I learned during my time in economic development was that I wanted to be in this asset class. And I'll talk about why here in just a second. I do Zoom calls every day. Usually I'm talking to an investor, either pitching a deal or explaining a deal. I'm not going to pitch on this call as much as I just want to educate. I just want to share with you all what we're seeing out there in terms of opportunities for real estate in general and with our projects in particular. I'll show you a sample deal. I just got one slide on a sample deal that we're doing now. Obviously, I look forward to your questions during the seminar. And any of you, of course, are welcome to talk to us after the seminar about going deep on any of our opportunities. But I just want to today give you a little high level because a lot is going on right now in the marketplace you need to be aware of if you want to be careful and smart about your real estate investing. First of all, why should you listen to me? Why is Denton Floyd a relevant speaker here today? So Larry touched on some of this. We really have become one of the premier development groups in this part of the United States, what I'd kind of call, well, you see where the states are, kind of in the middle and the southeastern area. We have over 6,000 units under management. This year, we'll do about 220 million in revenue. And we have integrated construction and property management, and our employees altogether number about 180 now and growing. We have under construction right now a little over $500 million of projects, and we have another 12 projects or so in our pipeline that would basically account for about another $750 million. So we have a lot going on right now. It's a very good time to be in the business, but things are changing, as I'll discuss in just a moment. What's really important to know, too, is that we have a presence in Indiana and the other geographies that we serve. We don't helicopter in as a developer. We really understand the market, the trades there, the suppliers, the dynamics. And right now, you'll see we've been successful largely because we really understand our markets. And I'm going to talk about a recent success with an illustration that Larry mentioned that we sold back in August. And I'll just mention here real quick, I'm going to show you a sample today of what we're doing. Just know we have a whole lot of things under development that I'm happy to show you that are in the pipeline. So let me go on to the next slide and talk a little bit more about what we're going to do here in the near term. You all know what's happening with capital markets, but just to hit on this from a developer's perspective, interest rates are much higher than they were 2 years ago, as much as 4% higher on our construction loans. Probably more importantly, the lenders have really tightened up their underwriting standards and their leverage points are lower. And that's what really affects the model more than the rate is, will they loan 70 or 75% on the project's cost, or will they do 60 to 65? That is changing as we speak. A lot of equity investors, like many of you and like us, have just kind of slowed down or paused, some on everything until they feel like what's going to happen with the market kind of settles down, some on specific assets. And this has all resulted in just fewer starts. It's taken us longer to get deals done. It's taken everyone longer, and that's affecting the number of starts. The next slide tells you how this specifically affects multifamily developers. Now, there's a negative and there's a couple positives. The negative, as I just mentioned, is that debt costs more than it used to. And as I just mentioned also, this really hurts when they don't loan as much on the project. Generally, the term sheet we'll get from a bank will start off at around 60 or 65%. A year or a year and a half ago, it would have been 75% on every deal. And closings are taking longer. But let me talk about the positives. In certain geographies, in certain MSAs or metropolitan areas in the U.S., exit cap rates have really not changed much. In fact, in some cases, they've gotten stronger. As you all know, multifamily is a hyper-local deal. What's happening in San Francisco, California, bears very little impact on what's happening with multifamily in Southern Indiana or Indianapolis. And we're going to show you how exit cap rates here are trending. They're actually trending very nicely. And we like the fact that in 3 to 4 years, when the projects we're starting today are going to be mature and stabilized and ready to be sold to a buyer, we're going to have less competition for our deals. There's just going to be a seller's market for those who can invest and can start now. As long as you've got a good location and the debt stack is right, I think it's going to be a seller's market in 3 to 4 years. So I believe very strongly in our exit projections, which we'll talk about in a bit. Next slide. I think this is about the U.S. So I thought it'd be helpful to show you this density map of the United States and Canada. Intuitively, I know more people live in the Eastern U.S. and you do too than the Western U.S. But until I looked at this, and I've seen this a couple of times, back in Make Development days, we always looked at this. It's amazing how much denser the geography of people is in the Eastern United States. And if you're going to look at a place that's right dead center to as many people as you can possibly get to, the star kind of indicates about where that would be. And it happens to be right there in the middle of the Indiana, Ohio, Kentucky area, right? And that happens to be where you're seeing a lot of in-migration of companies jobs and facilities that need to access people in a day or as quickly as possible as they can through a day's drive. If you go to the next slide, this is going to reiterate a little bit what Larry touched on. Indianapolis is benefiting from this very strategic location. It's near the geographic center of the U.S. population in the ES in the eastern U.S. With a car or a truck, you can get to 75% of the U.S. population. FedEx has its second largest air hub in the world there in Indy, so it's great for overnight transport. Larry touched on the interstates that run through Indianapolis. It is the major transportation center in this part of the country. There are daily direct flights, and Eastern time zone is a big deal, right? It's probably the westernmost state that's still in the Eastern time zone. So you can do business in Europe and the Western U.S. in the same day. And so it's for all those reasons, you're seeing companies and jobs migrate out of other areas into this part of the country and specifically in Indiana. Next slide. What's this mean for multifamily? Well, it means that supply still trails demand. There is so much demand for housing in general and for multifamily in particular that right now you would still see in any major part of the Indianapolis submarket that there is a strong demand and a lack of supply. When we write up qualifying renters for our properties, we use a rent-to-income ratio of 25%. And that's fairly conservative to some other places. I think in Canada, it tends to trend more toward 40% of one's net income would basically allow you to qualify for an apartment. We keep that ratio much more conservative at 25%. We want our renters to be able to afford our properties, and we focus on that class of renters. And maybe most importantly, because of what I just described, exit cap rates have really been holding steady in the mid fours. Okay, and I'll show you an exit we had in August in just a second. Okay, let's look at the next slide. We're going to go and talk now a little bit about a sample project. So again, my job here is I'm not pitching you all to invest in this as much as I just want you to kind of see the general structure and the kind of terms that we offer on one of our multifamily opportunities. The picture you see here, it's kind of our bread and butter. This is a garden style community. Garden style meaning these are 3-story buildings with common areas to access the units that you get through open staircases. There's 2 entrances on each side of the building. You don't need elevators. You don't need to cover and heat those common areas. People prefer that type of private entrance most of the time. That was huge during COVID, of course. But there's 24 units in every one of these buildings. We build this building over and over and over. We know how to build it. We know what it costs. We're very efficient at building them. We put a clubhouse and a pool in the middle of the community, and we drop these 24-unit buildings around, and we build Class A communities with really nice amenities. So that's the standard Denton Floyd widget, if you will, and we know our lane, and we do it extremely efficient and extremely well. Let me go to one slide.
Mark, if I could just interject here. So the opportunity here, you're presenting the Palladian Apartments. This is not just a sample though, right? This is an active project that you're seeking investment funds for.
It really, yeah, it is open right now. This is one that's available for investment if this particular project is of interest. Thanks, Dave. Yeah, I want to use one for illustration purposes that if you like it and you get your mind around it and want to actually dig deeper on it, you can actually invest in this one. This one's probably going to close with our bank and with our equity partners either end of the year, into the fourth quarter, or maybe in the first quarter of 2024. It's 3 to 4 months out. Let's go to that next slide, if you would there, Rod. Here's just in one slide what you might want to know about the project. This is a 312-unit project. Again, these are Class A, really nice finishes. If you look at the full slide deck, we do extremely nice finishes on the floors, the countertops, the cabinets. These are really nice amenities. This total project cost is about just under $70 million, and it's financed with $48.2 million of senior debt, which means we need $21.3 million of limited partners to pitch in on the equity. So that's the capital stack. And if you take that $69.5 million divided by 312, it's a cost of $223,000 a unit. Now, that's significantly more than it would have been 2 years ago. We were building for below $200 a unit, but it is less than we're seeing on projects we're going to be starting in 2024. And it's pretty competitive with what you're going to see almost anywhere in the United States right now. We get great efficiencies through guaranteed max pricing that we have in place with our suppliers. Because we have such a nice pipeline, we move our trades from project to project, and we have very good cost metrics on our project. So $223 a unit is the buy-in. Here's what we offer the limited partners who come in as part of the $21 million stack. This is kind of typical. You accrue an 8% preferred return. It's about a 2-year build. So sometime in year 3, we'll start generating revenue. As the cash accrues, when there is cash to start paying out, the first thing it pays down is the preferred return. Once we have returned 100% of that preferred return and 100% of the capital, the limited partners share in 70% of the net proceeds. Now, that's probably going to happen at a sale. So if we sell the property in 3.5 years, we get the money in for the sale, everyone gets their cut at closing, and then that stack gets divvied up according to the waterfall I just described. 8% preferred return gets paid in full, capital gets returned, and then it's a 70-30 split. And I put a 3 to 4 year exit because that's what we're seeing right now in terms of the cycle turn in this part of the country, in Indiana. We'll talk about some projects in just a minute that meet that criteria. If you look at our projected returns, we generally show conservative and a slightly more optimistic potential sale outcome based on the timing and so on. The range of multiples on your money based on what we project on this project is just under 2 to 2.1 on your money over that 3 to 5 to 4 year period. If you pencil that out in terms of an annual yield, it's about a 20 to 23% IRR. That's standard. I mean, if we can't get investors to a 20+% yield, probably need to go back and do some work on something, right? Either the split or maybe go back and see if we can do a better job on the capital stack, bring in something that decreases the amount of equity needed. We always try to aim for something in the 20s, low 20s for this kind of an asset class. And this is, again, one of many that we have in a line of developments that we can execute on. So I want to look forward to your questions, but any questions you have about these terms, just note those. And I guess, Dave, they're sending those into you for you to collate, right?
Yeah, absolutely. And by all means, everybody send in your questions in the Q&A at the bottom, and we'll get to those. And Mark and our other panelists will get an opportunity to answer those questions.
Okay. And just, the slide deck for this opportunity, and we put all the financials in there, a whole lot's about the market and the study. It's about a 65 slide deck if you want the full deck. We're going to spare you from that. I put it all together in just one slide today so you can at least get a feel for the project. Okay, let's talk about an exit. So this is a project that Larry referenced that he and his partners invested in with us that we sold in August, on August the 8th, at a 4.6 cap. This is in Southern Indiana, Jeffersonville, Indiana, which is where our headquarters is located. I just got on one slide here, kind of the key numbers. So this is a 264 unit project that we started in late 2018. And so we had about a year of construction that we were underway. We were into our second year when the pandemic basically hit and things got disrupted. So we had to push through construction and lease up on this one right really during the dead middle of the headwinds of COVID. The total project cost was about $30 million. Now, this is back in the day when cost per units were incredibly attractive, especially on something like this that had many Class A amenities, not quite as many as we have now. So this was a really low $113 per unit cost back in, what was that, almost 6 years ago. As I mentioned, we had delays during COVID, but we sold this project in August for $51.5 million. And so it's about $190 a unit. And that was at a 4.6 exit cap. If you take the NOI on the property and run it with that $51.5 million, that penciled out at a 4.6. That's what you'll see almost every sale that CBRE tracks in this region is going for, if it's a stabilized 90+% occupied Class A. And we feel confident that's going to hold. The limited partners in this case, they had terms that were very similar to what I just described on the Palladian. There was an 8% preferred return. On this project, the LPs received 50% of the net proceeds. So not as much as the 70. Part of the reason why the new deals are offering 70 is because it is a little higher cost per unit. And we do have to make sure that we adjust that yield so the LPs feel good about a 20+% return. But they were able to show a 20% projected return at 50 on this one. It projected out at 23.7, but we didn't reach that, again, for a lot of the reasons I mentioned. we didn't quite come in as strong as we thought, but we still pushed through, got the project done, got it leased up just after COVID. And ultimately, the IRR was over 20% to the investors. I had my partners who previewed this deck with me yesterday say, why are you going to show them one that didn't come in according to projections? And I said, well, I'd rather show them what we did in a bad outcome and show how that wasn't so bad, so that when we exceed expectations, they're nowhere being honest about how we project. So these are the real numbers. Larry can vouch for these. He was one of the investors as a limited partner. We generally are pretty conservative in how we write up the rents and estimate the sale price and ultimately the return. But we do feel very comfortable that we're going to come in somewhere in this 20 to 25% range on this type of an asset. So again, any questions about this sale, of course, make notes of that. I'll be happy to talk in more detail about this example.
Dave,
So
I'm going to chime in here, Dave, and maybe because we're on the topic, maybe we'll just subdivide the Q&As after each session here. And Mark, you can determine whether the question I pull here for you is better one-on-one, in which case Dave will take it offline with the person so we can do it one-on-one, or if it's something you feel our entire audience would benefit by for the answer. So the first one we have was just in general, is this a 506B or C offering?
I'm not quite sure I know what it's going to be on this particular project. So I'll have to get back to you on which specific offering it's going to be for the Palladian.
Okay, and again, so I don't see the person who asked this question, so I just encourage this person connect with Dave afterwards, and we'll make sure that communication channel remains. Okay. And the next question was, what are the fees on Palladium opportunities, i.e., the acquisition, project management, asset management? Can you speak in general to what the fees are in the opportunity?
Yeah, these are pretty fee-light projects. The only fees you'll see in the model, and these are all explicit in the full slide deck that we provide. So the general partner has a standard developer fee that in the U.S. pretty much every bank will generally accept. And it's again, depending on the size of the project, it comes somewhere between 2% and 4%. I believe on this particular project, it's a 4% fee of the total cost that gets drawn down over the life of the project. So generally 25% of that fee is approved by the bank at closing. And then as milestones are achieved throughout the lease up and stabilization period, there's another draw or two. And then the final 25% is drawn upon stabilization, generally around year 3. That's really it. There's also a general construction fee for the GC. If we had a third-party general contractor, we would be paying that to the third-party GC. But Denton Floyd has an integrated captive development and construction team. So we are the general contractor, and we take the same exact GC fee that we would pay to a third party just to cover the cost of our development team and our construction team. They work hand in glove with the property management team, which draws a standard, generally it's about a 2.5% or 3% fee of cash collected once we start leasing the property. So that's pretty much it. There's a property management fee that's in market, 2.5% to 3%. There's a GC construction fee for the general contractor. And then there's the developer fee, which gets drawn down with the bank's approval over the 3-year period.
Yeah. Now you touched on this briefly, Mark, but I'm going to elaborate this into another question, which is one of the inherent benefits we saw was, in fact, that Denton Floyd, with its in-house construction, whatever, there is an inherent risk mitigation when you can control the volatility of increased trade prices, supply trade. Just speak to that just briefly as if a question. If I was to say, the question was, Mark, what makes Denton Floyd different than the average developer that you get to control that others don't get to control from a cost perspective?
Yeah. So when I met Denton Floyd in 2011, they were a much different kind of developer. So they had maybe 20, 30 employees at that time. And the way they did business was how most developers start off doing business. They would go out, they'd find an opportunity, they'd pencil it up, they would go try to get financing to buy a project. Generally back then they bought existing kind of Class B, Class C properties. That's the first stuff that I invested in with them. And they would then contract and hire a general contractor, right? Someone like a Spectrum or one of the many GCs in the area. And there are some good ones. That's what they would do. They did that. And then they would, at that time, either hire a third-party property manager, like one of the nationals, like Lincoln or whoever, or they might actually hire maybe 1 or 2 people to kind of come in there and help manage the property. And that's what most developers do. They outsource the construction and they outsource, in many cases, the property management, and they kind of focus on development and investor relations. Well, as Denton Floyd matured and became a little bit more savvy at how to do these projects, what they saw was that there were dramatic inefficiencies when you near the end of construction and we're trying to start lease up, because you need those teams to be very integrated in creating models you can show, keeping certain areas of the property clean for people that are going to come in while you're still completing construction. We'll start showing the model unit and doing pre-leasing about a year into construction of a 2-year project. The project that we finished construction on last December, called Lakeside Gardens, when we finished construction at the 2-year mark, it was already 56% leased, because we had that integration between the construction team and the property management team. So it was the integration that we coveted by having that in-house, and also just the transparency. We wanted to make sure we knew where every dollar was going that we paid the GC, which then paid their subs. And we felt like if we could get visibility through to the subs, we would have a better idea of where there was opportunity to be more efficient. And ultimately, we would just have more control over the total cost of the project. And that's what you'll see. The cost of our properties, if you break it down in cost per unit, it's very, very competitive with the best developers in the U.S. We're extremely
great. You know what I'm going to do, Dave? I know we got a few other questions here, but we'll come back at the end. Let's move on to our next spotlight. Thank you, Mark. But we may still have some other questions at the end here, or we may take this offline and deal with them. We have captured all the questions. But Dave, let's move on, just in fairness of keeping the flow going forward.
Sounds good. Thanks, Larry. Thanks, Mark. Okay, so spotlight number 2. So we have a feature coming out of Kansas City, and it's a for sale property. And I would like to introduce Daryl McCullough. Daryl McCullough is going to interview Holly Mills. Holly Mills is the broker of the property. Daryl is a longtime friend, as I mentioned. And Daryl, I'd like you to come on and introduce yourself and introduce Holly for us.
Yeah, absolutely. So we first met Holly. John Brenner is a partner of mine, and we met Holly at an SEC meeting. Well, John did earlier than me, but she is now partnered with John and I, not only in a specific multifamily project doing the underwriting, but we have seen so much talent in this lady from Kansas City that and her extensive work in due diligence, which just really took us by surprise, actually. She's got upwards of 20 years experience with investment analysis and advisory services. Actually, she's the only Kansas City recipient of both the MAI appraisal designation, which in Canada is the equivalent of AACI, and the CCIM designation. She has a lot of experience in land assembly and development, specific valuation, consulting, and brokerage of large corporate assignments. And what I have found is she's a consistent student of investment development of the commercial real estate business. She is a definite student. And, I attribute her strategic application of market knowledge and insightful analysis of asset is a real contribution to our society now. And she's fairly new to it, but she brings a lot of great student attributes, and she is expanding her profile. So what she has today is a project called Plaza Point in downtown Kansas City. And Dave will have a full backup package for anyone that wants to get in touch with Dave afterwards. But this is the project we're talking about. This is downtown Kansas City. So Holly, can you hear me? Can you hear me? Fine.
I can. Yes. Good
Yeah,
morning.
okay.
I guess it's afternoon.
It's whatever it is. So tell us about Kansas City, and from a how I talk, and from an ABC location perspective, what would you give this, Holly, as far as location goes?
Well, Kansas City has been really on the move. I've lived in the area since the 1980s, and in the past 10 to 15 years, Kansas City has really been on an upward trajectory for a lot of reasons. We are central to the U.S. We're west of Indy, but lots of similarities in terms of reach into the U.S. Kansas City is, people move here. We've got kind of a famous lifestyle that some of the things we're famous for are barbecue, jazz, Our team just won the Super Bowl this last year. Expanding arts and culture beyond what you would expect for a city of its size. Corporations cite that they, always have Kansas City in the mix when they're looking for where to locate either satellite campuses or new headquarters because of the you have to forgive me if I sound a little nervous. It's because I'm a little nervous.
Yeah, I can.
So,
it's hard to hear you. Yeah.
Yeah, can you hear me all right?
I can hear you. So on an
Okay.
ABC basis, what would you give this location? Hello?
Okay. Location itself, this would be a Class A location within a Class A second tier and growing city.
Okay, thank you. And so as far as the building goes, can you tell us a little bit about the building, the age, and would you consider to be the condition of it from an ABC perspective right now?
Yeah, the building was built in 1971 originally by the developer was also an architect and GC'd the construction. So it's built it's very, very durable in its construction. It's actually rated fireproof because of its just being made of construction of concrete and steel. So really designed around the 1970s, what was considered spacious in the 1970s, and it's held up very well. We've had our construction manager through the property, and he confirmed that unlike what you would normally expect, a 1970s building to have some deferred maintenance issues, there's really no significant deferred maintenance. All systems have been upgraded to not just in the past, but recently. So there's really nothing to improve from a structural standpoint or the building system. So it's really a question of finishes.
So what would your tenant profile be here, Holly?
So people move. This is in an area called the Country Club Plaza. This is one of the nation's, if not the original. In 1922, it was founded. It was the first suburban shopping district, and a live, work, play that has been operating on all cylinders since live, work, play became a term, really. The profile of people who live here for that very reason. We've got everything from downsizing, baby boomers moving in from some of the more distant suburbs, to young up-and-comers who are looking for a place that they can live and have access to all of the arts and entertainment in the area, as well as, of course, the shopping and eateries. This property is 2 blocks from the plaza itself. And so we've all heard walkability become a term and something that's championed, particularly in the multifamily space. And a couple of the features of that are walkable to transportation. We're within a 15-minute walk of the new extended streetcar line, which is connecting a huge swath of Kansas City that hasn't been connected since the 1960s. And so really able to achieve some of that modern trend as well as be established over a long period of time.
Okay, good. So we're going to, because of timing, I'm going to make some assumptions here, and then, so we have we have 1, 2, and 3 bedroom large units. Right now, the existing rent is coming out on average for all 3 of these 1, 2, and 3 bedrooms at only at $1,350 a month, which equates to $1.14 per square foot. Why is it so low? Why are the rents so low in such a high quality location?
Great question. So this has been owned by the same family for 46 years. And we'll talk a little bit more about the ownership in a moment. But the strategy, as you often see in privately held assets of that kind of an ownership profile, they want to avoid vacancy. So to maintain occupancy, they keep it 98 to 100% full by not raising rent. So really, that's the only reason. There's nothing
He wants to keep it full. So talk to us about the ownership background, then a little bit deeper with the ownership background, please.
So this is the last remaining multifamily asset by a family in Kansas City, owned by a family in Kansas City named the DeVinkies. They at one time, as recently as the 90s, had over 2,500 units in Kansas City. They've been involved in commercial real estate, and particularly in multifamily, since the 1950s. And so very seasoned, but as the generations have turned over, the current owner is 77 years old, and he's moving towards the exit, so to speak, by divesting of their properties, simply as he's positioning his own estate, looking down the line. So
he has transitioned down from 2,500 doors down to this final asset. Have you closed with him? Yeah. Have you closed with him before?
I have.
Okay,
Bought a medical office building 3
you have
years
a
ago.
relationship. Rod, is there any more pictures besides the one that's in front of us by any chance? So I think I've walked this area. This is a very high profile quality area in Kansas City. You can see the background of the blue, and behind is the subject property. So, what I'm thinking about this is, what is the situation? I mean, we talk about him wanting to get out, but let's talk about the real situation for a second. I mean, we have a project that, and some more of the numbers that you and I went over, you can take this thing from the upwards to $2 a foot overall, and have very large units from $1.14 a square foot by putting some rehab to it. And we did the numbers. You've done a lot of research on this. You feel very comfortable in that $3 million range to turn this into something that is, because the bones are good right now, so it'd be about $2 a foot from the low number we just talked about. And following up on what Mark Crane talked about, depending on how you structure this deal, you may be getting north of the 18% IRR for a building that's already there, if it's looked at in a specific way. What do you think the owner would do to assist in this transaction, Holly?
Well, that's a great question. So he said the words out loud, "I know I've missed my market," because we've had a massive shift in the past 2 years. And so he has wanted to get involved in providing, he knows that financing is a huge factor in what's been the market change in the multifamily category. He's offering seller financing. He'll finance up to $22 million of the, by the way, we didn't discuss it, but the asking price on this is 28, which is $28 million, and he'll finance up to 22, and then it's at a 5% interest rate, interest only payment, but he'll allow it to be paid out as 3% for the first, and by the way, he'll do 48 months, 3% for the first 2 years and 4% for the next 2 years, because he wants to he wants to help the numbers pencil. So knowing that anybody looking at the multifamily space is considering the cost of capital right now, he's stepping in a very meaningful way and willing to carry paper for 4 years.
Okay, so he'll offer seller financing. So how can you assist, Holly, from where you are? How can you assist? We're not around Kansas City. Help us get to Kansas City as far as an investment goes.
Let me tell you briefly about our firm. I'm with a firm called Clemens Real Estate. It's been active in the multifamily development space for 20 years. They have about 1,200 units under management, so we have a full-service property management division. We also have asset management and construction services that we can bring to the table. So we can make referrals across a variety of different services as needed, but also have those in-house so we can help provide some context for as you're as a potential buyer is vetting the cost of owning and operating this.
So if somebody come in and says, I'd like to maybe create a partnership, would Holly be interested in being the eyes and the active part of the partnership in Kansas City? Would you
Yes,
consider that? Would you consider
absolutely.
looking at that based on your background and your understanding of developments? And the fact that you've
Yes,
been through this whole project with the folks that can do the rehab. So you're pretty familiar with this marketplace, wouldn't you say? I'm trying to put words in your
Yes,
mouth.
I live about
Okay, all right.
I live a mile from the plaza, so just this, I drive by this multiple times a day. My mother owned a condo of half a block from here. I know this multifamily and condominium market very well because of the home base that was there for a very long time. And then in the real estate space, you can't do valuation or brokerage work in Kansas City without this being kind of part of the context and the conversation. So I recognize the value of this asset, not just because of the mismatch in terms of its current operations, but because of, as you touched on briefly, but there's sort of two places you could take this opportunity. Because it's so far below market, I've forecast a market rent just on an as-is basis to be able to grow within the first 12 to 18 months to $1.65 a square foot. Without even, we're not talking about a $3 million investment. That's just a modest investment to spruce up amenities to help retain as much of the current tenant base. But and then as the market should change and capital become at a friendlier cost in the coming several years, at that point, to be able to do a comprehensive, if you think it's merited, you'll have so much insider intel on the property operations, you can really choose whether or not it makes the most sense to go ahead and take the property to the Class A end of the rent to the $2 range, or whether to own and run it as a well-maintained asset and on more of an as-is basis.
Okay, thank you. So Dave has a copy of the full backup package, which is very in depth and available to people that are on the call. Feel free to get to Dave. But at the end of the day, what Holly is talking about, she's seeking offers or letters of intent. Share with Holly what you will do to make a transaction happen, and see if we can help her get over the goal line with it. She's prepared to stay in. She's prepared to be part of it. She's got a lot of opportunities that you can turn this asset into something very positive. So thank you, Holly. Thank you for being my partner. And thank you for your in-depth work on this assignment. Thank you. I guess I'm done, Dave.
Thank you.
Yeah, Daryl and Holly, thank you very much. So now, everybody, we mentioned that Q&A is your opportunity to ask questions. If we don't get to it on this webinar, we'll make sure that we follow up afterwards. So put your questions in now if you've got them, and we'll make sure we walk you through next steps. So Rod, if we move on, I just want to remind you, so part of this process, right, is to identify, validate, and here we are at the spotlight. So you've seen a couple of opportunities to invest and to buy into, and that's all part of the process, right? This is about collaboration, this is about creativity, and this is about connecting people. That's the whole purpose of this webinar. So anybody that wants more information on the Denton Floyd opportunities or the Holly Mills opportunity in Kansas City, right, you're going to be able to rewatch this webinar on our website. The URL is up there. Thank you, Rod. And you're going to be able to connect with me and ask your questions, and I will put you in direct contact and make direct introductions to both Mark Crane and his team and Holly on the Kansas City property there. So please reach out, come and find us. We're here to make those connections. So again, now, My name again is Dave Price. You see my phone number up on the screen. You can call me, text me, you can email me. Up on the screen here, you've got the barcode where you can scan that on your phone to make a direct connection to me. So we will make this a very efficient, streamlined process. These are vetted opportunities with very quality individuals that know what they're doing. They're very well experienced. So we're in good hands here. So don't be shy. I want to thank everybody for attending. We've still got a couple of minutes here. This has been great. Thanks again, Mark and Holly, and to our guest speakers. So thank you, everybody. Don't forget, we've got another one of these coming in November, on November 22nd, where we'll be featuring at least a couple more opportunities for Canadians to invest in U.S. real estate. So thank you for your time. Thanks to the guest speakers. Really appreciate your time, and we'll see you again soon.